The loan to value ratio, or LTV, of a mortgage can mean a lower interest rate or a higher one. And today, I'll explain exactly what that means. Roll the intro. LTV, or loan to value ratio, is a common used term in the mortgage world. On a purchase loan, it's the buyer's skin in the transaction. And on a refinance, it's the homeowner's equity into the property. But before jumping into all that, I'm Damien L.Grant, a licensed mortgage advisor, and in this video, you'll learn what a loan to value ratio is and how to calculate it. So, what is loan to value ratio all about? Well, by definition, the loan to value ratio is the percentage of loan in comparison with the value of the property. And while banks look at a lot of different things before approving the loan, please believe that LTV is a critical factor. For owner-occupied homes, the common LTV is 80%. Most banks want to see home buyers come in with 20% of their own money. Now, of course, that's not the case for all home buyers. That's why banks offer low down payment mortgages. And for those that go with the low down payment under 20% route, please believe that your mortgage is going to come with a premium called private mortgage insurance, or PMI, which is added to the loan if the bank lends more than 80% of the appraised value of the home, just in case the buyer defaults on the loan. Now, if you want to learn more about PMI or private mortgage insurance, I'll leave a link in the description below. Now, in qualifying, banks use LTV on purchase and refinance transactions. And keep in mind, the math used to calculate the loan to value ratio will change based on the purpose of the loan. For the purchase of a home, the LTV is based off the purchase price of the property, unless the home appraises for less than the purchase price. In this situation, the property's LTV is based on the lower appraised value, not the purchase price of the home. Now, with the refinance, the loan to value ratio always goes off the appraised value, not the original purchase price of the home. So if you're doing a cash out refinance, your LTV is critical and will be the deciding factor on how much money you can pull out of the home. Now, calculating the LTV is really pretty simple math. Here's how it works. Take the loan amount and divide it by the purchase price. Or if it's a refinance, divide by the appraised value. For example, let's say you're buying a home for $200,000 and the appraisal comes back at $205,000. Plus your 20% skin in the transaction is $40,000. Your loan amount will be $160,000. $160,000 loan amount divided by $200,000 purchase price, which is the less of the two, gives you a loan to value ratio of 80%. Now, here's another example if you're refinancing. Let's say your home appraised value came in at $200,000 and you have a $160,000 loan amount balance. 20% equity into the property is $40,000. $160,000 divided by $200,000 gives you a loan to value ratio of 80%. Now, if you look at it from the bank side, a lower loan to value ratio is a sense of comfort. When the LTV is too high and if the loan applicant defaults, the bank more than likely won't recoup its original investment back if they had to sell the property for a discount at a foreclosure auction. Now, on the flip side of that, if you're fortunate enough to put more money down or to be in a low LTV situation, you will be rewarded by the bank with a lower interest rate, which means more money in your pocket and less in the bank's. So what do you think about the way banks look at loan to value ratios for a mortgage? Leave it in the comment section below. And if you're applying for a mortgage, I've written a free 10-step guide on the do's and don'ts before you apply. Make sure to grab that below. Now, if you like this video, smash that like button, subscribe, share it with your family and friends. Comment below on how helpful you found this video and what your biggest takeaways were. I look forward to receiving your feedback and giving you some responses as well. I'll see you on the next video, and thanks for watching.